Good morning. Good morning. Welcome. As people are jumping into the session, we really appreciate you being here with us today. This is completely live. So you're both, well, I don't know, Rudolph, I don't know if he's freezing. I was fine, but now I don't know. Like the more the time goes, I'm in Joburg at the moment. So yeah, it's a bit cooler than what I'm used to. But anyway, so thank you very much for everybody that is joining us. Thank you very much for taking the time to learn a little bit more about Taxspace. Taxspace is a tool that I developed back in 2016, December. I spent my entire December building this out in an Excel spreadsheet to solve a problem that I had. And that was a very simple one at the time. And it then became something so much more over the years. And we really developed that until we had the opportunity to develop this into a fully fledged online application. That's now a proper application with nice looking reports and all of that. But there's so much to Taxspace that we feel people just don't get it. You know, they think it's all about tax, and it is. There's a lot of tax involved, and all the other tools that we built in, there's always some tax element. But it doesn't mean that you need to be a tax expert. You do need to know something about tax. You can't know nothing. We haven't been able to build such a good system that will just do it for you. But maybe with AI, Rudolph, we'll see where we go one day. But yeah, this is a fantastic tool, and we use it to create opportunities, but also we use it alongside other planning tools and all sorts of things. So it's really, really powerful. And I don't think there's a better way to show you what this is, because I can sit here and do you a demo, that's fine. But you know, to hear from somebody who uses it with clients on a weekly basis, regular basis, extracts a lot of value from it, then I think it's great to have Rudolph Geldenhuys with us today. For those of you who don't know Rudolph is one of the how do I put this, Rudolph? Like, I want to say you're one of the co-founders, you know, of Firecrest, you know, and you're director at Firecrest now. So just went into his own FSP together with Gareth, and yeah, so that's been going. And then also, he's also the current financial planner of the year of the FPI. His reign is coming to an end shortly because the next conference and next winner will be announced in November. But that's sort of Rudolph's story. And as I said, he's a user of Taxspace. He uses it actively with clients. And I'm looking forward to hear how Rudolph uses this with that and to show you. And then also, if you've got any questions, please do share them with us in the chat, and we'll be happy to answer those at the end. And then also we will share more information a little bit later as well of how you can try this out for yourself. But anyway, on that note, Rudolph, thank you for your time. Thank you for joining us. Thanks for being a Taxspace user, and yeah, excited to see what you've got to share with us this morning. Thanks very much.
Great. Good morning, everybody. It's wonderful to be here with all of you. And please, I want to make this session as interactive and engaging as possible. So I'm not sure from Heike if that is a hello or if that's already a question to start, but I'm going to keep an eye on the chat. So please do interject, please do ask questions, and I want to make sure that this is valuable, the session. And most importantly, what Francois alluded to, we're going to, I mean, Ben, don't you just want to add the link in the chat right now so that everybody's got it? This is one of those tools where you have to play with it, right? It's like trying to buy a car without test driving it. It makes no sense. You need to see, would this fit me? Would it fit my process? So there's literally, I think, a 10 Rand trial that you can do to figure it out. Taxspace.app, click on the link in the chat. Make sure it's in one of your browser tabs so that when we leave the session, or in the session, if you've got two screens, please create your profile, log in there, get the process started and test it out, so that you can see where it fits into your process. But I think what I want to briefly share with you is some real life applications where I use it and where it forms part of the discussion. So there's, I guess, three key things I want to share with you today. It is two of them around the traditional tax planning. And what I love about Taxspace myself is it's not just a tax tool, it's a conversation tool. Because nobody wants to pay more tax than they have to. In actual fact, everybody wants to pay a lot less tax. So how do we do that? Well, number one, we need to see what tax deductibilities clients have. And then, especially in the retirement space, we can proactively plan a client's future income. And we can plan it more tax efficiently. And using this tool, you can demonstrate to a client what the impact is. I think other things that I'm not going to touch on, but things that you can let your mind wander is when you start making financial planning recommendations, you can actually demonstrate the impact. Because let's say that you come across a client and the investment strategy is in complete shambles. There's 17 different accounts with no real strategy. It's just things that they've accumulated and some of it's gained value. So now you want to consolidate, simplify, and create an overarching strategy that's going to help the client from a cash flow perspective get from where they are to where they want to be, but it's going to trigger capital gains tax. So how do you demonstrate that? Well, I think this is one of those tools that you can show to a client what the impact is so that you can do proactive tax planning by splitting gains over multiple tax years, because it's helpful and it's important. I mean, yes, we need to realign strategy, but we have to do it intentionally in order to reduce taxes. So that's sort of the kind of three elements I want to share. Number one is that pre-retirement space. Number two is somebody that's retired. And then number three, part of cash flow modeling is oftentimes figuring out strategies in order to put a client in a better position. And the home loan calculator built into Taxspace now is wonderful. If you haven't seen it, I'll show it to you. It really, really moves the needle. So I'm going to share my screen. And again, I'll keep an eye on the chat. So please, if there's any questions that you might have, please just drop it in the chat and we'll tackle it. So I'm going to use Mr. Retired as an example. I'll use myself as another example, and then I'll show you the home loan. So at the outset, to create a client is super duper easy. You click on create client. It's really bare minimum info that you need to capture. Date of birth is helpful because that will determine what kind of rebates you get from a tax perspective. So let's say that I use myself as a pre-retirement example. So if you click on the drop-down scenario, every time you do a scenario for a client, it will automatically save. And what I like about this, it's almost like you do versioning, right? So this is where you can create a strategy. Say, Rudolph, this is where you are today. If you were to implement my recommendations, this is how your tax position would look like, and that's how it impacts on your cash flow planning, right? So for example, we would do that when we think about future savings for, let's say, retirement. Then we can say, well, if you were to increase your retirement contributions for the sake of your retirement, this is the positive impact on your taxable income. So even though you're contributing an extra 1,000 Rand a month to your retirement, from a tax perspective, you're getting 200 Rand back from SARS. So this 1,000 Rand retirement annuity is actually only costing you 800,000 Rand, never mind the fact that it's tax-free growth, etc., and outside of your estate, all the important things. So that's what I like about it. So within the client that you create, you also can keep a version of different kind of scenarios that you created. So if you did an investment comparison, let's say this is where you have a conversation around the consolidation of retirement funds, and it is going to be Section 14 transfers, and it's maybe moving from old school life-based products to new generation LISP investments. We all know that there is a big cost difference between those two, even coming with some transfer penalties. So you can then use the investment comparison tool for that to just illustrate what that looks like. This time at the end can definitely show you that. But the home loan repayment one that I also want to show you, especially when it comes to cash flow modeling, is the incentive, number one, of paying off your home prior to one of your key dates like retirement, because it saves on interest. So that's a massive benefit. And number two, you can then also calculate if you were to put additional money into someone's bond, what the timelines are that they're going to save. So this is like the F&B bond calculator, but the fact that it's saved and it's really comparative, which is cool. You can illustrate bonus payments at certain key points. And then it says, okay, instead of paying the bond off over 20 years, you paid it off over 10 years. So then it shows me the date, and I can use that in my cash flow model to say, well, Rudolph, you're 34. If you don't pay your home off over the 20 years, so at 54, but you do it over 15 years, so then at 49, then in my cash flow plan, I know that from the age of 49 until my retirement date, let's say 65, what I freed up from a bond repayment perspective, plus the additional money, I can plug that in straight to Rudolph's cash flow plan to see if that moves the needle, because Rudolph was never used to spending it, so he might as well keep saving and investing or enjoy some of it. And this tool is really great for that. So that's the kind of scenarios I want to just quickly touch on in the next few moments. So let's go to the tax scenario. This is where it all started, as Francois said. So let's use a calculator. If you click on the use calculator button, this will start a new scenario, or if you want to edit an existing scenario, you can. What I would recommend is, if you're doing proactive tax planning for a client within the financial planning process, I would create a scenario, finish it off with all the base information, then come back to the client and copy the scenario. So what I'll show you, so this is the current scenario, no idea what I input over here. So let's have a look. Okay, it's a blank one, so that's cool. So here's my scenario. The scenario settings is not too important for this conversation because I want to get to the actual tax component. So as you would sit and think about your client's life, and this is where information like a client's payslip, information like the previous tax year's assessment, that little ITA 34 assessment is helpful. You get that assessment once somebody submitted their tax return. A few minutes later, that ITA 34 pops up. That's helpful because it gives you all the information on where all the income sources are, what is actually triggering all the taxes, and then you can start inputting it in this way. But let's say I paint a scenario. Rudolph comes in and sits in front of me and said, listen, I need help with my financial planning. These are all the areas that need some attention. I don't know where to start. We cannot give advice without considering tax. We all know this. But then we can't just give theoretical tax advice. Y'all remember, more contributions to retirement funds is obviously a tax deduction. That means nothing for a person who does not do their own taxes or who has got exposure with tax. Talking with a doctor, like, this makes no sense. So let's demonstrate it. So very simply, client earns a annual salary of 100,000 Rand a month, so it's 1.2 million. Automatically, you can see on the right hand side how interactive this tool is. So if we just say, yeah, and we need to probably do the bonus that I get from the practice, I get a divvy or a bonus of 200,000. Then all of a sudden you can see what happens in this client's financial and tax position. You see the marginal tax rate, so that's physically the tax bracket according to the SARS tax tables, but then it also shows you the net rate. And why the difference? Well, think about your rebates that you get, your interest exemptions if applicable, if you make RA contributions. What the net rate is essentially demonstrating is most clients are very caught up in the I pay 41% tax. That's not true. But we need to educate. And if we start educating our clients more by showing them, it's not just telling, but showing, then they go, oh yeah, okay, cool. I'm still upset with SARS, but I'm not like furious now, because out of every rand earned, I'm only paying 32 cents in tax because I do get some money back. Yeah, some of it's delayed, I get that, but this is helpful. And why is your net tax rate so valuable? Especially when we get to post-retirement, where we want to help clients earn a more tax-efficient income. And then if we start drawing from multiple sources, the net rate becomes really helpful as a conversational and financial planning tool. So all of a sudden here, I can see immediately what's happening in this client's life. And if you have business owner clients, which you all do, this is a helpful tool, especially when they're grappling with, do I take more salary or do I take dividends? Because you can illustrate. If you want to pull 1.5 million Rand out of the business, is it better to do it 1 million Rand through income tax or through dividend? But remember, then you need to take into account the fact that this is personal tax. It's not looking at the business tax. So it's first paid corporate tax at 27, then you need to pay divvy tax. But this marginal rate gives you that cue of, if you're in the 45% marginal tax bracket, probably starts making sense to draw more dividend than salary, but this is just another piece of the puzzle for the conversation. What you can also add in here is if there's payslip items like the little SARS source codes, because somebody through their corporate fund has got retirement contributions, it's important to bring that in because that's part of their package, but then it's also, remember, a deduction on that side. Annuities for your retirement clients that I'll touch on in a moment. This is where you bring in your annuities that you can put in, and especially if a client's got multiple annuities, name it for the client. It's as simple as clicking on the plus and saying, okay, well, here's my life annuity with just because they've got good rates at the moment, and that I get 100K from. And I've also got a living annuity with, I don't know, let's pick on 91, and that's at that 4% drawdown. So now the client knows, oh yeah, of course, 4% is 400,000 Rand for the year. All of a sudden now you can start seeing what's happening at the right-hand side of the client's life. So it's just great because it actually gives the client something to remember and think about as they go through their planning. Now, in my scenario that I'm building here is a salaried employee or somebody generating their own income. Now, we know that there's not a lot of opportunities for clients when it comes to their own, sort of, yes, I almost lost my train of thought now for a moment. Apologies. So there's not a lot of scope for a salary earner, right? If you have a 3601 SAR source code, you're liable for tax. So what are some of the things that we can do to reduce taxes? Well, it's pretty much retirement annuity contributions and looking at the investments within a client's portfolio to make sure they're as tax efficient as possible. So if we then go to the income block, which investment income is one of them as well, if you get an ITA 34 or you just get the source of income from a client, and because they're maybe, I guess, risk averse, you know, there's very conservative clients that don't necessarily want to put the feelers out, we can tackle it twofold. Number one, cash flow modeling will show them that by not having a very high level of return over time in your investments because it's conservatively positioned, so it's bottom left of the efficient frontier, not top right. We're not going to get compound growth, so that might not lead to all of the outcomes. But then another nice incentive to get the clients to behave their way to wealth, which Andy Hart always says, I think you can show them the tax benefit that they can get by doing that. Because if they've got 2 million Rand sitting in a cash account, it's very simply to illustrate 2 million times at 8% interest. So there we go. There's another 160,000 Rand in interest. Now it does deduct the interest exemption automatically because that's the maximum allowable interest exemption, but that doesn't really move the needle. That means that on the difference of the 160,000 Rand interest income, we're still paying about 140,000 Rand in taxes. So by creating a scenario one and then making a recommendation and comparing that side by side, you can influence the client to make the decisions that best serve them and why it makes sense to reallocate the money from cash into something that's maybe more appropriate for their financial planning and for their cash flow. So I think that's using it. This is something that I do with clients regularly to say, okay, let's just get a sanity check on what is going on in your financial life. Income and investment income. And you can obviously add dividends here. Now dividends doesn't, I mean, if let's put in a 200,000 Rand dividend here, you'll see that it didn't change your net tax payable. Why? Because I've already paid the 20%. But what it does is it reduces your net rate. Did you see the net rate drop? It went from 32% down to 29%. Now this is one of those things in aid of the conversation where, yes, if the dividends are reinvested, it doesn't really affect your net rate. But for a post-retirement client, what are we trying to do as advisors? Give them enough income so that they can enjoy life. But income sources are so wide, and we should probably plan so that the income is more sustainable and more diversified. So yes, they get their pension. Yes, they maybe start enjoying some of the interest. Yes, out of their share portfolio, they maybe have the dividends paid out to them because it all fills the gap. I need 100,000 coming into my bank account to make sure that I can enjoy life. Whether it comes from my divvies or whether I'm selling a few shares or whether it's from my pension, I know I'm getting 100,000 in a month into my account. But what is our job as the financial planning professionals? We want to make sure that the 100,000 coming in is the most tax efficient. So clients more often than not, as you would know in your experience, is there's some kind of a mental block against selling shares. But unless your CGT is 100%. So you bought for R1 and it's now whatever it is, R1,000,000 of that investment, which is very unlikely. I'm not saying it's not very high, but it's very unlikely. It's obviously more tax efficient than pension income. So this is a way to demonstrate to clients where the reason we're also starting to enjoy the fruits of the growth and the gain from your share portfolio is because it reduces your net tax rate. So we start enjoying dividends, we're selling some capital. So if you want to demonstrate that, I think one way to very simply do that is by saying, okay, I'm bringing in the dividends because it's not reinvested because we're getting it paid out. If it's reinvested, I mean, then we can't do anything about the 20%. I mean, that's done at sort of product or company level in any event. But let's say, okay, we say to the client, okay, but we need to fund a total of 100,000 Rand. And you can see here why I'm getting into sort of do mode and advice mode, because those two scenarios I wanted to show you, the pre-retirement and post-retirement, they're all just gelling into one as we're talking. So I promise I'll come back to that. But now we're saying, okay, well, let's stay on the retired client for the moment. If we say, well, we need to fund income because there's an income need. Let's then have a look at, okay, well, we are going to then draw some income from those sources. So if we say that because we want to bring it in to show the client what the income is. So, but I can't put income from their investments, if it's not pension, into their gross income, because it's not gross income. But I want to show them what is their sort of disposable income to match that up to the cash flow model. So then I want to say, okay, well, it is a income, so I'll just put it under other income. So I'm drawing 200,000 Rand from that unit trust. But it's not income tax, so I'm going to exempt it for the time being under an other exemption, just so that it takes it out of the income tax category. So then we're back to the same position where we were. So let's say that is unit trust withdrawal or selling of the shares in the share portfolio. But then I need to account for the CGT, right? So then under the taxable capital gain, not under primary residence, also not under small business, you'll change it into other. And then I'll say, okay, the market value was 200,000 Rand of the unit trust withdrawal, and the base cost, because when you go onto any of the platforms, you can do a CGT scenario. So it almost shows you the estimated capital gains tax or the estimated base cost on that sale. And let's say this client had a lacquer return, so they had a 50% base cost. Now I can account for the fact that there is some tax payable based on this scenario, the fact that I'm selling unit trusts, but it's not income tax, it's actually just CGT. So there you can see the taxable capital gain is 24,000 Rand out of this. Compare that 24,000 Rand capital gains tax payable, which obviously goes into your income. Compare that to if you just rather draw 200,000 Rand more from your pension. Look at the net tax payable. So let's make that 521. So somebody remember 521 for me, please. The income is in and out, and we rather draw 200,000 Rand more from pension. So let's just use this life annuity, 200,000 Rand. Hold on. Can you see the difference? 520,000 Rand tax payable as opposed to 600,000 Rand, right? So that is a significant difference in tax payable. This moves the needle. This is a 60,000 Rand tax saving by just reframing where the income sources are. Now, assuming there is some unit trusts that clients can do. So I want to really make a case that if you are looking for a tool, because yes, there are some online tools, yes, there are some like Excels you can build, and again, if they're working for you, great, but the reason you're here is because you're looking for something better, and I believe this tool could solve a problem specifically for the version. So let's say this is my current client scenario. Rudolph, the salary earner, earning 100,000 Rand a month with a bit of a bonus. There's no sort of other income. Maybe there's a rental income, and you can obviously account for that as well. This is sort of gross rental, and then you can go through the deductions, what is available. But I think for the salary earners, let me just take out some of this stuff I input here before I forget about that. Back to capital gains tax, we took out that one, and we took that 200,000 Rand out of gross income. Okay, so for salary earners, what is one of the few levers that you could pull from a tax perspective? Well, that's obviously retirement funds. So now I can say, okay, I know that the client is currently making a contribution to a retirement fund of, let's say, 10,000 Rand a month. So 100,000 Rand for the year, 120,000 Rand for the year. Automatically, when you enter that, it recalculates your net tax payable. Well, obviously, because you've got 120,000 Rand less of taxable income because of that. So this is my current scenario. Before we started proactively planning this client's tax environment, we actually had a look at what is your current scenario. So Rudolph, you're paying 41% marginal tax because of your 1.4 million Rand income. There is a bit of interest because of your 2 million Rand money in the bank because you haven't done anything with it yet, whether inheritance or whether just saving or sale of an asset, and you are making a slight contribution to retirement funds. Okay, cool. That's the scenario as is. You're paying 29 cents on every Rand's worth of income. How do we better the scenario? Because that's the point. We want to move the needle. So now I go back to Rudolph under scenarios, and I would now copy that scenario. So are you sure you want to clone this item? Of course. So that's, and then it goes to copy. You can rename the scenario just to make sure. So this would be then, let's call it scenario 1 or advice 1. And now we can start playing around and say, okay, well, if we are able to reduce your taxes, because that is of obvious importance, what is the maximum that we can contribute to an RA? Well, we know it's 27.5% or 350,000 Rand, but that's like unnecessary calculation if you have the information. So let's start with 350,000, the maximum. And then in this client scenario, you can see there at the top, the deduction is stopped at 350 because of the level of income. But let's say that the client didn't earn 1.2, because I want to illustrate what the tool can do on your behalf. Let's say that the client only earned 600,000 Rand with a 200,000 Rand bonus. Now, the 350,000 RA contribution, if you look at 27.5% of that income of 800,000 Rand, plus obviously some of the investment income, the tool automatically tells you what the maximum is. So instead of guessing, you can simply do the maximum and it tells you, okay, cool. If we contribute 257,000, the maximum that we can do to RA contributions is 257,455. Anything more than that means we're not getting the tax deduction, so that's going to a disallowed contribution. Does a disallowed contribution make sense? Well, if you consider 10C, it could, but it's also an asset in your estate if you pass away, so then it's about what your beneficiaries choose to do with the retirement fund. But a 10C or a disallowed contribution for post-retirement is cool because then you can get some tax-free income. But again, you're the expert, you know all of that. The clients don't, but here you can make a case for it. We know we're only getting a 257 deduction. The reason we're making an additional contribution of more than the tax deduction is for a efficiency or a tax benefit or some kind of future benefit that the client will have. But Mr. Client, if you were to go down this route, what is the impact of moving your retirement annuity contributions from 120 to, let's say, the maximum in that first scenario that we had, to make it just more comparable to the first scenario I had? So currently, we've got somebody that is paying 462,000 in taxes. If they were to up their contribution to the maximum, then all of a sudden it drops to 368. So I'm still in the marginal tax rate of 41%, but there's a dramatic difference now to my net rate, and that's what moves the needle. Because you can't do anything about your marginal rate, because that's a bracket that you fall into. But when it comes to your net rate, which is, and now for this client, if we go now back to the first scenario, because you can easily toggle between the two, and that's helpful to show the client pre and post, instead of paying 462,000 Rand in taxes, Mr. Client, 29 cents for every Rand of income. Now all of a sudden that drops to 360,000 Rand. So it's only 23 cents in tax for every 1 Rand. So that additional contribution of 350,000 minus 120. So that 230,000 additional contribution to your retirement fund reduce your taxes by 100,000. So the 230,000 Rand investment is only costing you 130,000 Rand. It starts to move the needle, especially for clients who are concerned about RAs for political reasons, for prescribed asset reasons, or they just gutful because they were in Sanlam-based products on the old life stuff that pay a lot of commission, not to you, but to the guy that sold it 20 years ago. And it's just not growing because of the cost. So they want to contribute more, but the thing hasn't performed. So why would I add more money into an asset that, yeah, I know the tax deduction, but doesn't really make a difference? Well, this makes a 100,000 Rand difference. Okay, cool. Now I'm ready to explore actually the new generation type of retirement funds where I'm in control, access to the information, and I can see that it moves the needle and it's cost effective. What are we doing by showing clients how we're going to change their tax position? By having a tool that we can play around with, where the client can see the inputs. They can say, okay, but what about this? What about that? What would be the impact, Rudolph, if I were to maybe do something with that cash? I've been thinking about maybe selling that cash investment and buying a property. What would that look like? Or I maybe want to invest it. Well, I mean, all of a sudden now conversations come up. If you're in a marginal tax rate of 41%, now we need to grapple with the net tax rate, because it's easy to recommend an endowment when you look at the marginal tax rate. But we probably should look at net tax rates, right? Because would a client be better off or worse off of wrapping their 2 million Rand cash in an endowment, assuming no liquidity issues, right? So don't hear what I'm not saying around the 5-year restriction period. But yes, other policies have got multiple access points. I get all of that. But just practically, if you wrap 2 million Rand of cash earning 8% in an endowment with a client with a 41% marginal tax rate, it's either go, yeah, but an endowment is 30% where you 45%. Not true, because the net tax rate for this client is 23%. So now in a wrapper, you are making them pay 7% more tax on the interest compared to if they just did it themselves. But the difference is they don't feel it in the wrapper. That doesn't mean they don't pay it in the wrapper. But again, you know your client, you know the behavior. So then you can speak into those different kind of elements to the client to say, okay, well, these are your options. This is why your endowments are no longer moving the needle. You may be in your previous job, pre-retirement, you were earning a boatload of money. You were earning 2.4 million Rand a year, plus a healthy bonus of 600,000. So you earn 3 million Rand a year. I mean, most doctors, specialists, earn that amount of money easily. Now, it's a different story making a case for an endowment, because now they're in the 45% marginal, but their net tax rate is 33%. So now we are going to be 3.65% more tax efficient if we wrap it in an endowment, if we do cash for cash. But now all of a sudden, part of the additional benefit would be to consider from a capital gains tax perspective, if we wrap some of their share portfolios or some of the unit trusts, not in open plan architecture unit trusts, but in endowments, because we can have the same asset allocation, right? So this is helpful to start illustrating to a client why your advice is what it is. Not just theoretically, but practically show them, well, an endowment has 30% income tax, you're paying 33% income tax. We're going to save 3%. 3% matters on an income of 3 million Rand a year. 3% in tax doesn't really move the needle if you earn 10,000 Rand a month. Sorry. But for clients in these sort of upper brackets who are coming to you for advice around, I just need to pay a bit less tax, I don't want to pay 1 million Rand to SARS, then this is a helpful way to demonstrate that for a client. And again, around most clients that you engage with, multiple different asset types. So they have rental properties, they've got business interests, they've got medical aid. I mean, it's helpful to move the needle on medical aid as well. I mean, here you can show them some of the impact of some of their expenses. So medical aid premiums paid by you, so 10 grand a month for medical aid, and there's 4 people on the medical aid. It automatically calculates your medical tax credits. So that's helpful. If there's a disability, then there's even additional medical tax credits that you get. So that just builds it in. Again, this is pretty much the SARS online wizard in real time, where you do it proactively. Instead of after the tax year trying to just do a post-mortem, this is planning for that post-mortem so that it's as tax efficient as it can be. And again, I think this is one of our value adds as financial planning professionals. We don't just give advice on insurance. We don't just give advice on investments. We don't just give estate planning advice. We make sure that you've got tax efficient income. That's a big deal. And this is a tool that can help you do that. I think if you start working with clients around repositioning of portfolios, again, this is exactly where you would illustrate what the impact is in the current tax year for a client if they want to reposition assets. So they've got a share portfolio which is no longer moving the needle, it's stressing them out, they want to simplify. They don't want to keep paying CGT every time the share portfolio manager or stockbroker makes a change in the portfolio. They want to swap to unit trusts because you've explained to them the benefit of, well, you only trigger CGT when you take money out of the unit trust, not when changes are made within the unit trust. What you can do is you can demonstrate that. Cool, Mr. Client, your share portfolio is 5 million Rand. Your base cost is 1 million Rand. So it's pretty much 80% gain. We need to reposition it to stop that future tax and almost to not let it run because that market value will just keep running. But every time there's sale of shares, you're paying tax, but you're not actually getting money from it. I understand paying tax if I were to physically get some money because I made the decision. But I mean, you all would have been on the receiving end of phone calls with clients saying, why am I paying tax on money that I didn't withdraw? It's a fair question. Now, maybe the tax or the stockbroker did explain that to them. But it's one thing, again, cognitively understanding it and then feeling it in your pocket with a pay-in at the end of the tax year. Because remember, those things aren't pay as you earn. So you need to plan for those tax payments. So now we can say, okay, well, let's have a look at what the impact in this tax is if we just sell that portfolio. So 5 million Rand market value and 1 million Rand base cost. Taxable capital gain, 1.584 million. Again, no, this was nothing like, this is just math that we did here. So nothing funny. But obviously the taxable capital gain gets included in your annual gross or taxable income, right? So now all of a sudden, by doing the full sale of the share portfolio to reposition for a client in this tax year, let's just make that 0 for now. So current tax payable is 1,050,000. If we were to sell the whole thing, that becomes 1.7 million. So an extra 700,000 Rand in taxes. So I'm getting 5 million Rand from my investment. I'm paying 700,000 Rand to SARS. That's not great. So then, if it's maybe more like appealing to the client to split it over tax years because they're not too pressurized to do it, then you can demonstrate the same thing. Say, okay, well, 2.5 million and 500,000. Okay. Now it's less than half, remember, because the net tax rate on a full sale, so it's not a linear thing that happened here. You're exponentially reducing the impact if you split it over 2 tax years because we had a 700,000 odd Rand, just a little bit more, payable on the whole amount because it pushed the net tax rate up. But because we halved it, it's actually less than half tax payable. So that's, again, something that you can illustrate. It can be a really nice talking point with the client to say, what do you want to do? I think we have to get there over time, but if you want to split this out over 3 tax years, over 4 tax years, and we can manage it, absolutely. We try and mitigate that through retirement contributions as well. In this scenario, I've had the full contribution, but some clients might be making other types of investments. So in that scenario, what could also help the client is to say, okay, I need to sell that investment, or I need to sell the property. I want to get out of that property, but I'm going to pay CGT. What can I do to reduce that? Well, if you're selling that property for 2.5 million with a base cost of 500, it's going to lead to about 784,000 taxable capital gain. It increases in this specific tax year your tax payable by, let's say, odd 400,000 Rand. But if we were to max out your RAs in this year, then all of a sudden that reduces the tax burden by 50,000 from where it was. So again, by having an extra 150,000 in an RA contribution, we can save 50. So again, there's so many levers to pull, but in this scenario, you can actually demonstrate that. But the power, just before we end off with some, are there any questions? Let's have a look. There's a couple of things in the chat. Let's just see here if I can answer anything. Yeah, Andrew, absolutely. How expensive living annuities are. And that's why we ultimately always make the case to say, when you get to retirement age, you want to have at least some money in voluntary assets because they're more tax friendly and they also allow you to have larger access points, larger lump sums. Because if you need to create liquid lump sum amounts available for a client, what do most people do? You up your living annuity income. So you do an annual payment instead of monthly, maybe from 6% to 17.5%, so you can get money for that car because it's a big living annuity. What does that do to your income tax? Skyrockets in that 1 year. But if you have two assets, voluntary and compulsory, you can find a more tax efficient income. And yes, I agree with you that you can still do RA contributions for a tax deduction, even in retirement. Get the tax deduction, loop it back into your living annuity, both outside of your estates. It reduces the tax payable. And yeah, not a lot of people do that, but it's helpful. And then, Andre, at which point do you link the tax savings strategy back to the lifetime cash flow? Okay, so what we would do now, we would play with scenario one. So just the scenarios are not comparable. And I remember I changed a couple of things. So if you look at the first scenario, Mr. Client, you were paying this amount of tax or that amount of tax, and what we're going to do through strategic changes is it's going to, let's say in the post-retirement space, we're going to have an increased income with a reduced amount of tax. Then you would take those inputs and add it to your cash flow model. You would then say, okay, my current income that I'm drawing from the assets is R1,000,000 a year. We also need to draw out the tax component because it gets deducted, or we need to make provision for it. So then we say, well, what is then the impact of your cash flow model if we're able to reduce taxes strategically in that way? So this would give you the cue of, I need to prep and plan for this client that there is a 3.5 million rand income, and we need to make sure that there's 1.4 million rand available from a tax perspective within the cash flow model. And then you can look at the impact of the cash flow model as you move the needle in that way. So yeah, that's maybe some of the questions that I see in there. And then the very last thing that's so helpful is the home loan repayment tool. So I just quickly built one this morning, just as a quick update. So here is the current scenario. We have these conversations often. Currently, you took out a 2.8 million rand bond, and based on the interest rate of prime minus something, let's say 9.5% on a 20-year bond, most clients don't ever see this. They signed up for it when they actually take out their property loan, but they don't realize that the 2.8 million house that they live in is going to cost them 6.2 million rand over the period. That is not great, because it takes away your cash flow, because it means that you pay that amount for 20 years in order to pay that interest. So we want to make sure that you pay off your home early. It's a great strategy because it actually increases your net asset value. So now we can demonstrate a whole bunch of things. Like I just added in here a 15,000 rand a month additional payment into the bond, and if we do that, we save 2.2 million rand in interest, and we repay the bond 11 years earlier. Why is this helpful? Well, if we go to the graph at the bottom, a 2.8 million rand property will cost 26,000 rand, but if I add the additional, then I can see that obviously it's 26 plus 15. So in that scenario, I need to repay 41 a month. But now the client's used to paying 41,000 rand a month. They're not used to enjoying it. So what can you do from a cash flow model perspective, to Andre's question earlier, when would you put this in? Well, then I would simply look at, okay, well, if it's 11 years early, that means I pay the bond actually over 8.5 year period from today. So if I go to Rudolph's cash flow model, then I would say in 8 years time until retirement age, what will be the financial implication if I were to put that 41,000 rand into the investment portfolio for that time period? Because you're not used to spending it, so don't get used to spending it. Put it towards your future and see what positive impact that is. So this is just cool to demonstrate. If you build multiple scenarios, you can show the impact very quickly of, if you do a 10,000 rand a month additional payment. So you save 1.9 million rand. So there I put in a 10 grand a month instead of a 15. But Mr. Client, you have a bit of extra money, or you get bonuses every year, pop it into your bond. All of a sudden now with an extra 5, you have an additional 300,000 rand interest saving, and you shave off another year and something off your bond repayment. And again, what I like about this is you can keep those versions. You can see as you make strategic recommendations. This is essentially, I guess, the basis of the 6-step financial planning process that we all have to adhere to. If you look at all of our exams we ever wrote, and we look at all of the blueprints of what a financial plan should or could look like or has to incorporate, it's what are we trying to answer, clients? Am I going to be okay, or how do I move forward? This is where you are, current and proposed. Current, proposed, and then you can show them the difference, because that leads to better behavior and better outcomes. So let me just check for more questions. Do you use Honan calculator to show the effects of vehicle financing? You can. You can simply change the time frame. It's not a vehicle calculator, but remember this is amortization, so it works the same. So all you would do is you would just simply do this over 750,000 rand car on a 10% interest over a 5-year period. So then it would show you the same. So you can absolutely use this as a vehicle sort of financing calculator. The only thing that you'll then need to just consider is the looming balloon payment that sits outside of it, if there is one. But other than that, you can do exactly the same. If you're saying, cool, well, at the end of the year with your 750,000 rand car, did you know that car actually cost you 1 million rand because of interest? No, I had no idea. I could afford what is the repayment on this? The repayment on a car is 16.5, because I could afford the 16,500 rand payment. I just thought it's cool. But okay, you're getting a bonus at the end of the year. We're going to do an ad hoc one of 100k, putting it into the car at whatever. Let's say it is December, the 1st of December, when your bonus gets paid. All of a sudden, that drops your interest with the 60,000 rand. So by putting 100,000 rand into your car, you are saving 60,000 rand in interest. So you win 8 months. So yes, you can absolutely use it as a vehicle financing one. And again, those versionings are so helpful to do multiple scenarios. How would you charge the client for a benefit that's derived from using this tool? I wouldn't charge them additionally per se. I think it just makes me more valuable in their lives, so that the fees that they are already paying me, that they get more and more value from them over time. I mean, it's the same question of saying, well, I mean, we use different financial planning software. We moved from Xplan to Advice Tech or Asset Map or to whatever. And now you're saying, oh, you want to charge a client for that? You can't. It makes me more efficient. It makes my F&As better. It's more proactive. It's more engaging. It changes behavior better. But I think what it does is, and you probably could charge for it, I guess if you have hourly consultations, then you can make a case for, if you want me to do a specific tax consultation for you, a tax consultation costs 500 or 1,000 bucks, and then whatever the charge is for the tool on a monthly basis, I mean, then you can say, okay, I just have to do one tax consultation per month, but it makes me a better financial planner. And yes, you can show the outputs on PDF. So if we go back to, for example, the one tax scenario I created, let's say tax scenario 1, I love this little addendum, because a pre and post addendum is wonderful. You can just print the addendum, so it literally comes up as a PDF straight into your into a PDF document that you can save in the client's folder. Again, it just sums up gross income, it sums up domestic interest, it sums up RA contributions. There is, for example, if there's taxable capital gains, if it's applicable or not, it would say that. So in this scenario, you can see what's going on there. You can see the medical aid. And then also if you click on the full report, so view the report, you can then either just work through this report with a client, or again, it's print to PDF. And then you can say which sections of the report you want to add into it. And you can then, I think this is probably the best page, this. page 3 of 9 out of this report. This is where if you have a pre and a post, you were paying 35 cents on every random income. We were able to drop it to 20 cents. That moves the needle. And then that's part of those things where if you ever get to a position where you need to defend your value proposition, because clients sometimes are funny, and I get that, like they want to pay less fees because sometimes they think the more fees I pay, the less money I'll have. We know that's not always the case. Sometimes it absolutely is. But they just chat with somebody at the braai going, hey, like there's my guy's great and he doesn't charge me a lot. And you might have to defend your position. And then part of your value proposition is, yes, Mr. Klein, I know you pay me 0.75% on assets, and that's whatever, 30,000 Rand a year. But remember last year when we changed your retirement income, and this is the process we went through, we saved you 500,000 Rand last year in taxes. So my fee of 30 grand is actually moot. And then I think it's important that we remind the clients of the value. But yeah, I think the funding element is what you make of it, but this just makes you more efficient and it makes you better at your job. It's live and interactive, and yeah, I think it's definitely great. If I understand better, the program doesn't replace the client's tax practitioner, but enhances my services, which in case can be complementary to a tax practitioner. Yes, absolutely. Unless you submit the tax returns, and you also then help a client proactively do it, you would do both. But no, it doesn't replace your tax practitioner. And let me tell you why this tool is so valuable for me. Because tax practitioners don't do what we just spoke about. Tax practitioners, at the end of the tax year, when all is said and done, all that SARS is waiting for is their payment, they just submit tax returns. And it's not that they don't want to be proactive. They just don't have the capacity because they sell time. Remember, they sell time in exchange for money. So for them, it's about, I need to get your tax certificates and I need to like submit your returns to make sure you're tax compliant. They're not there to make you tax efficient. That's our job. And we need to tell clients that's what we do and engage in that way. So no, this is making you better. And then you can also help your tax practitioner or the client's tax practitioner, show them how you made their clients more tax efficient so that they can think about other clients within their base that's not a client of yours to say, listen, but John always moans about taxes. Maybe Tabelo can also help them become more tax efficient so that they maybe hate me a little bit less. So again, it's just valuable to demonstrate actively and with clarity how we move the needle in terms of our financial planning process. Because tax efficiency is an ongoing pursuit. Every year, it's a case of where we're at, what is the income you need over the next 12 months, and where can we reduce some taxes? How can we become more efficient? And how does that move the needle? Because if that percentage goes down, if that 35% on the left drops to 25%, that means it is a 10 Rand on 100 Rand saving that the client has in their own pocket, which they can either enjoy or save for the future. So yeah, I think on that bombshell, that's all that I wanted to share with all of you today. I hope it was helpful and that you are keen to get stuck in. Please get the demo and play with it. That is where you'll get the most power out of it, to see how it will move the needle in your next client meeting, for tomorrow's client engagement, for next week's annual review, to see how you can shift the needle in that space.
Brilliant stuff. Thanks, Rudolph. Some good questions, some great things that we want to know. There's a couple of things I maybe just quickly want to add to, because it is important. This whole thing around charging, right? So I have users who charge us 4,500 Rand to do an analysis using this tool that takes them 5 minutes, and clients happily pay it. I think we're at a point in, whenever we bring something into our business and you start expanding your value proposition, there is an opportunity there to charge, right? So you should do what you feel comfortable with. I'm very much a proponent of, look, use this tool to make money. So it could either be that you just do a value add and that somewhere leads to a business deal or doing business with a client that you can't necessarily link directly to this. But there's also many instances where you would be able to do that. I'm sort of halfway through developing just a bit of a model just to show you, because some people, it also depends, I think, where you find yourself in your business. But there, I'll show you, like, if you, for example, really want to use this tool for prospecting and finding new clients, how that can help you and what that means actually in rands and cents for you. But I'm only halfway with that. I only get to work on it when I'm on an aeroplane, and then sometimes I've got other things to do on the aeroplane when I'm traveling. But we will show that hopefully in the next couple of months or so. But that's a very personal decision, right? So I'm of the belief that, look, this has got tons of value. As Rudolph rightly said, I mean, I was a tax practitioner. This is why we built this, because I promise people like you that I will give you insights. And that's why I built the tool. But most uh, practitioners are like bookkeepers and accountants. They work on deadlines and they just want to get the stuff through, and they give you a little Excel summary that says exactly what your IT34 is saying. So there's a lot of value that one adds here, and a lot of opportunity that you unlock, and you can change the conversation, right? So if that's possible, you decide, is it a value add or is it a product that you are selling as part of your proposition? So I think that's up to you. And then just to get back to Andrew asked a question earlier in the Q&A. He was asking about financial advice giving versus tax advice. Which one has to be a registered tax practitioner, as I understand, in terms of giving an opinion, for example? How easy is it to overstep the mark and open oneself to risk? Now, as far as I understand, I was a tax practitioner. I'm no longer one. But if you helped clients prepare tax returns, and you submit the tax returns on their behalf, then and you charge money for it, then you have to register as a tax practitioner. I don't know if that has changed, but that was the rule. And we sold our tax practice at the end of 2019. So I'm not sure. I haven't kept up with that part of the regulation, but it's surely something we can also look into. So it's not so much about the tax advice, it's about the tax services that you render. So it's more to do with the preparation of the tax returns, etc. I mean, tax advice is part and parcel of the of giving financial advice, right? I can't see how we're still ignoring this. Like, it's really critical, but it's only once you get into the tax return preparation and submission part that you have to be a registered tax practitioner. But we must just maybe double check that, Ben. I'm not. Yeah, just remind me.
No, listen, Francois, you're 100% correct. If you were to do the submissions, then you're liable. But when it comes to tax structuring, you don't need to be a registered tax practitioner. You need to know what you're talking about. But that's for everything that we do, right? I mean, if you give advice on an investment, but you don't know how that investment works, you're on the hook for that. But like we have to give tax advice. I'm talking about tax returns. I'm talking about in the business of giving financial advice, where you come to me, Francis Rudolph, what do I do here? Like, I'm about to retire. This is my assets. This is my life. I need 50,000 a month to live. I can't say, okay, well, just take it from wherever. And then ignore tax. It's going to be a case of, well, if you draw it from here, this is going to be sustainable and this is the level of tax payable. But if we draw from your voluntary and your compulsory, we're able to get you the same level of income with half the amount of tax. I don't need to be a tax advisor to do that. In actual fact, if I don't do that, I'm actually not doing my fiduciary responsibility of giving the best advice, because it's going to move the needle.
Yep, brilliant. Then there's before we sort of share just where you can learn more, but so Andrew is also asking a bit more of a technical question, so I'm happy to answer this. So at the moment, Andrew, you captured it. We asked, I mean, you saw in the beginning how little info we actually ask for. It does get stored in our database, which is a Google Firebase database. So it does get stored there, but we at the moment don't offer API integrations. It is on the roadmap, but it's not top of the pile at the moment. Yeah, so it's like name, surname, date of birth, and email address. That's sort of it. And the only reason we ask for those things is so that we can determine. We didn't want to keep ID numbers and things like that. So we're just trying to determine that there's no duplicates and things like that. So we use those indicators to help us. But yeah, so that's the sort of answer to that at the moment. Good stuff. Right. I think I'm going to cut it there, Rudolph. I've got to go and do talks. But also, like, we are really appreciative that everyone has stayed here till the end. I think we lost like 3 people because of, I think we said this is half an hour. So sorry we went a bit over because we are so excited about all of this. Brilliant job. Thank you very much, Rudolph. It's really amazing to see all the different ways that we can use this in practice. There is a 10 Rand 7-day trial. If you haven't used the system before, you get a 10 Rand 7-day trial. When you sign up, you automatically get it. And then if you cancel within 7 days, you won't be charged the full amount. If you stay, then it's $3.90 a month. And then for Taxspace clients and Propulsion members, you pay 351 Rand. So those codes are available from Taxspace and also from us, or it's for the Propulsion members, your code is on the platform. So if you just go to member discounts, you'll find it there. And when you sign up, you need to put it in when you sign up, and the system will automatically apply those discounts. Everything happens online. You manage your account online. You manage your card online. Like, everything happens online. So there's no debit orders. It's card payments. Yeah. So I think that's sort of that. There is training available on the site. So once you log in, you can only see it when you log in. There will be a training link, and you can get started there. Obviously, you can reach out to us as well. There is a little chat button on the site where you can get directly in touch with me. But big thank you for joining us. Really appreciate it. And let us know if you've got any questions. Rudolph, dankie vir jou tyd, Amaat. Ek waardeer.